Like most couples that have just retired, they've done a really good job saving. In fact, they're a 401k millionaire. But now they're realizing that the majority of their nest egg is in pre-tax money and the challenges that come along with that. In this video, we'll dive through the strategies that we use to help reduce the impact that taxes have in retirement so you can have more confidence in your plan and ultimately do the things that you've set out to do. If we haven't met yet, I'm Kyle Kuyat, a certified financial planner and co-founder of Defining Wealth. And in today's video, we're going to walk through a case study of how we helped a client navigate these similar challenges. Also, if you want to try the tool that we've used in this video completely for free, check out the link down below in the description.
All right, everybody. Today we've got the Skywalker family that we're taking a look at here. Anakin, Padme, Luke, Leia, the whole family. And Kyle, I know you like that.
Big fan. Big fan. I'm glad they kept it together and Anakin decided not to go on the dark side in our scenario.
Anakin's 64, Padme's 59. They've got 2 kids. And when we go over to their goals, pretty standard, right? Anakin's been retired since late last year. The retirement expenses, they're trying to spend $6,000 a month. They want to take annual family vacations with Luke and Leia, and they want to leave an inheritance for their kids. So we've got all of those goals baked in here. And as you can see, we're always going to assume there's this retirement annual long-term care cost towards the end of the plan, just trying to be conservative there. So as we get into this plan with Anakin and Padme, we're looking first at what do you guys have saved up already? So they have some funds in the bank. They've got their joint checking, their joint savings. This is cash that we're going to use either for a buffer if they need to live off of some cash for a while if the market has a downturn, or just really for them. In this case, it was more of a comfort thing, wanting to make sure they had some cash available to them. And then there's Anakin's 401k. So 1.1 million just about. And again, this is all pre-tax money. So that means whenever Anakin and Padme want to take a vacation, when they need to spend on groceries, whatever it is that they need to do with this money, they're going to pay income taxes every time they take it out. That has some downstream effects on things like your Medicare premiums, the amount of taxes you pay on Social Security. All of those things are affected by taking a significant amount of money out of a pre-tax account. So we want to make sure that we avoid some of those issues down the road, in addition to also lowering some of the RMDs they're going to have to take, which are those required withdrawals when you reach age 73.
So Anakin is like a lot of other retirees out there in America today where they are 401k millionaire. They've done a good job of saving, but there are some strategies in order to avoid some of the consequences like you had previously mentioned, Jake, as far as how much taxes they're going to have to pay between now and for the rest of their life, and even maybe some of the taxes that their kids may have to pay. And that's something else we'll get into here in a little bit.
Retirement planning can involve many trade-offs. So let's look at some of the key goals that we help them identify and prioritize. When it comes to their goals, they wanted to ensure that they had enough saved for retirement first and foremost, and can live comfortably and confidently throughout their retirement. They also wanted to create experiences with their family by continuing their tradition of going on family vacations. And they also prioritized leaving a legacy to their kids above their monthly expenditures.
So when Anakin and Padme first came to us, we had a base scenario where retirement was kind of on edge, right? We felt okay about how much they'd saved. Again, it was all pre-tax, so we were a little nervous about that. And then running this through 1,000 market scenarios, we looked at it and said, hey, we don't have a very high level of confidence here with the retirement plan. And so we needed to make a few adjustments. And one of the easy ones, and we talk about this a lot with our clients, just controlling what we can control, right? You can retire later, you can spend less, or if you're still working, you can save more. And then there's things, of course, like Roth Conversions and other, additive strategies we can go to make retirement a better experience, give you more after-tax wealth. But some of the basic things we can control are how much we spend. Now, they did not want to take out annual family vacations or leaving something behind for their kids and grandkids. That was important to them, right? They didn't want to eliminate that from the plan. Their attitude was such that they wanted to spend less on a monthly basis if it allowed them to do annual family vacations and leave this inheritance for their grandkids. So we said, hey, if we spend $5,000 a month rather than $6,000 a month, that kicks us up to a 70% probability of success. Just means 70% of those scenarios were successful. That's something we manage over time, but that makes us a lot more comfortable than that 58% success rate. As you can see, we have multiple sources of income from the plan. This is going to be true for most people. You have your retirement assets. Sometimes some folks have a pension. That's rare these days, but some folks still have them. And then we have Social Security. And you can see that here. We've got Social Security starting at age 68, so full retirement age for Anakin. And this goes up over time. I mean, there's an inflated amount that comes in, but also Padme gets her Social Security once Anakin gets to age 73, and they double up there. And you can see if we skip over to the withdrawal rate, you can see that this helps the withdrawal rate go down. So from over 5% to begin with to about 2%, 2.5% in the middle there. And then when Padme starts taking Social Security, it really does go down significantly. What we see here as we get further into retirement is required distributions on top of what they're spending from Social Security. That's what kicks up this withdrawal rate. And that's something that we want to try and lower and help them avoid being required to take that money out, because it, again, kicks you into different tax bracket a lot of times. It forces you to take money out of your portfolio that maybe you didn't need, especially if Social Security is going to cover a lot of that spending going forward.
Although we can't go back in time and save Roth dollars, just because you have the majority of your wealth in pre-tax accounts doesn't mean that you're out of options. Let's take a look at how Roth conversions can impact your overall retirement plan.
So as we've said, one of our goals for Anakin and Padme was to lower the amount that they needed to take out when they hit RMD age, but also the deeper goal there, the higher level of what we're trying to accomplish is lowering their tax bill over time. One of the ways we can do that is with systematic, strategic Roth conversions. And we want to do this before they take Social Security. We want to do it before they reach RMD age, or else the plan's not going to work. So one of the things we worked on with them is how much of your tax bracket are we comfortable filling up with these conversions? And we landed on about 12 to 15%. And you'll see that reflected here. As we go through the plan in these early years until RMD age, we're actually converting until both of them take RMDs, right? And so this is allowing us to create more tax adjusted wealth at the end of the day in their portfolio. Some of that money is going to have taxes paid on it when we do the conversion, but that means there's more and more money stacked away in these tax advantaged Roth or IRA accounts rather than continually eating away at it through RMDs throughout retirement.
We get the question all the time of how much should I convert to Roth? And my answer, as any good financial planner, would be it depends. Let's see how over converting can actually be a bad thing.
Yeah, we can see there is kind of a diminishing return, right? When you hit a certain tax bracket, you can see we're converting pretty much everything they've got here in the first couple of years. And maybe that does end up with more than doing nothing. But at the end of the day, the goal here is to end up with as much as possible while paying as little tax as possible, which is why we landed on this 12 to 15%. Again, leveling out that kind of tax journey, the amount of taxes that they're going to pay in any given year, and ultimately increasing the after-tax wealth that they end up with. Wealth that they can spend on better vacations, wealth that they can spoil the grandkids with, wealth that they can pass down to Luke and Leia if they so choose, and sometimes even in a bigger way than they initially planned with the 200,000 they initially talked about.
Roth conversions can involve delayed gratification. In fact, a large part of what you gain from Roth conversions is limiting your future tax liabilities, federal taxes paid, and RMDs. Let's take a look at the impact that this had on the Skywalkers.
You can really see the difference in the plan when we break it down specifically into RMDs, and then we'll talk about the tax payments as well. But you can see here the RMD amount in the darker shade. This is what the new plan has in terms of how much we have to take out. It's just over $2 million less than the first plan, which had us taking out an immense amount of RMDs, money that really they didn't need to spend on an annual basis, but were forced to take out because of the IRS rules, which, you know, the rules are what they are. But again, this is really why we're trying to limit that. And to take it one step further, you look at the federal taxes paid, it's almost $300,000 that comes out of your portfolio to be paid to the IRS over the lifetime of your plan. And instead of paying it all like this and then spiking at the end, because remember, we're assuming we have some long-term care at the end that we have to pay for. Those are big expenses. If it's all pre-tax money, it's a pretty significant outlay of cash that you have to give to the federal government. So what we want to do, as we've said before, is just level out this ride of paying taxes instead of having these spikes and then seeing it go up exponentially with those RMDs later in life.
Obviously, if we can kill two birds with one stone on the same strategy, which is less taxes paid over time towards the end of your life, and also more money for either yourself or your loved ones later, then obviously that's a win-win strategy.
So to get all this on one page, we can go to this summary here. So you see pretty significant difference in the tax adjusted ending assets. Again, this is money that goes to your loved ones. This is money that you can spend on vacations, trips, helping send the grandkids to college, any of that, any of those goals that you might have, or even aspirational goals you didn't know you would be able to afford, hadn't even thought that you might be able to afford. It really does change the dynamic of your retirement plan as you get into your later years with the tax adjusted wealth that you have. Here you can see the original strategy would have had under $1 million of wealth if you include the taxes that are taken out of it. And the proposed strategy, because that money is tax-free and it grows tax-free and then comes out tax-free, you have over $3 million of spending in your portfolio that you end up with because, again, the taxes have already been paid. You've already paid the bill. You've controlled the tax situation to your advantage rather than paying more and more taxes at the end. And that difference is shown here, right? The difference between doing the Roth conversions and paying taxes on your own terms or paying it on the IRS's terms with those RMDs, it's significant. That's what leads to this higher tax adjusted wealth. And then, of course, you can see here the difference of taking money out of a tax deferred account versus the tax free. This all filters down into what we're paying in taxes, and ultimately back to the most important number: what can I spend? How much will I have? Will I be okay to spend X amount of dollars on the goals and things that make my life enjoyable and helps me to pay for these things that I want to do with my kids and grandkids?
So one of the secondary goals that the Skywalkers had was to leave money behind to their kids. Not only are the tax adjusted ending assets more, but obviously whenever their kids are inheriting this money, if Anakin and Padme had already paid taxes on this money, it's going to be much more preferable for their kids to be inheriting Roth dollars versus pre-tax dollars.
The rules on how they take this out have changed. So instead of handing the kids, $1 million of taxable money that they would have to pay taxes on, taken out over a 10-year period, that could significantly impact your kids' tax situation when they inherit this money. Now they're handing them $3.1 million of tax-free money. And that does have to be taken out by the 10th year, but it's not going to hurt their tax situation. And really, the benefit of these Roth conversions are being felt into the next generation, even as they inherit them long after you're done using it.
Thank you so much for watching. If you enjoyed today's video, please do us a big favor and click like. And if you'd like to see more content like this, make sure you go ahead and click subscribe. I'm Kyle Kuya.